off the sidelines. So you actually have labor supply, people that didn't have a job looking for a job, people that used to have a job and stopped looking, now they're coming back because it's been a pretty solid labor market. And that's very different than what you tend to see when the unemployment rate rises. It tends to be driven by people losing their jobs. And that just hasn't been the dynamic. Now, could we start to see that play out? Sure, but again, I think when you're in a backdrop where inflation is continuing to slow down, people still have pretty solid income growth, and put those together, that means real wages are rising. That's going to probably continue to be supportive of companies retaining staff. And so that's kind of the breakdown in my view. You had a lot of people worried about the unemployment rate suddenly starting to spike. And in our view, we just didn't have the conditions there. So again, I think there are some risks, and that's exactly why the Fed has shifted to basically defending the labor side of that mandate. So the way to think about it from a Fed perspective as you look into the December meeting, their next decision is this idea of the balance of risks. So they're a dual mandate Fed. They have to manage the risks to inflation and manage the risks to labor markets and growth in the economy. And when you look at this backdrop, as Mike just kind of ran through in terms of the inflation backdrop, inflation risks just to the upside aren't really all that strong. So where are your risks greater? Right now they're in the labor market. So the way I think about it is the risks to unemployment rate rising are greater than the risks to the inflation rate rising. And what does that mean? That means that the Fed should probably be easing policy slowly to make sure that we're cutting off those downside risks to growth and preventing a recessionary type environment for setting in. So all that to say, that's how I think they're guiding the policy framework is moving forward into next year. And what that suggests for December is you probably expect to see another cut. And then as Mike mentioned, only pricing in about 3 to 4 cuts over the next year. That probably means that they're going to start to be a little bit more measured, a little bit slower. Maybe instead of going every meeting, they're going to go every other meeting. But the data is going to dictate it. But for now, labor side of the mandate is clearly what their focus is on, and that dictates that they should probably continue easing policy.
I love it. I don't usually do this, folks, but I want to give you a little insider tip here about the finance industry. The way you can tell a financial analyst is they all dress the same. I don't know if you noticed that here. But this is a thing. This is a very true thing. And so if you see someone dressed like this, you know what they do for a living. All right, eeny, meeny, miny, mo. Mike, you get this fun one. So there was an election last week. You're getting it. You also wrote it. There was an election last week, as we all know, and the markets rejoiced to some degree, having the best single week, I think, in all year, and bond yields went crazy, they spiked. What do you make of that? And with this sort of change in regime that clearly has happened, what does that mean for the economy moving forward in your eyes?
Yeah, and look, it's hard to put into context, 1,000 different policies and conversations we can have. But at the end of the day, it comes down to an administration coming in, like 2016, that's probably going to have policies that are going to be much more pro-growth, right? And pro-growth, you've seen it. One of the big things was that bond yields rose quickly. I think everybody wants to insinuate, and Garrett and his team put out great numbers on this, so I'm going to steal it, that when the bond yield, how far it rose, everyone wants to attribute it to inflation entirely. So the expectations of inflation is going to run, so bond yields are moving up very quickly. But when you look at the numbers, the reality was it's only about 1/3 of the rise in bond yield was attributed to higher inflation expectations. The other 2/3 were to higher expected GDP growth, right? And that's the key. It's just a more pro-growth environment. Same playbook as 2016. You saw small caps run. You saw value stocks, more traditional cyclical stocks, really start to rally. And as you probably expect with a more pro-US policy, you saw international stocks lag. So with the rise in bond yields, you saw fixed income drop pretty quickly. But overall, I think really the story comes down to the pro-growth environment. And I think the conversation we'll have with a lot of people is the deficits of deficit spending. What happens? How does that affect interest rates? How does that affect anything? And look, that policy is both sides of the aisle. No one wants to address it. No one will address it. The key to making deficit spending work is you have to outgrow it. Everybody wants to talk about, how much the deficit is and how much our debt is. Well, if you increase your GDP growth to a level that kind of makes that number smaller relative to the size of your economy, it's okay, right? Otherwise, it can be a problem. But we've seen it over the last couple of years. Deficit spending has remained steadfast. However, we've seen GDP growth outrun it. So, look, if there's going to be more deficit spending, there's going to be likely deregulation, lower taxes. I don't think I'm telling anybody anything surprising. I think the moral of the story is that it's likely a more pro-growth environment, and we saw that with how markets rallied over the last couple of weeks.
You guys concerned about deficit, or are you one of these deficit myth believers?
Yeah, I'm one of the myth believers. I think the debate has to not be whether we're on a sustainable path. I don't think anybody would stand up here and say we can just continue doing this forever. We can't. But I think the bigger story is that there's no kind of preset line in the sand where you cross that in terms of debt to GDP ratio, and your economy is just going to go up in smoke, and interest rates are going to go skyrocketing. Not a great example in terms of a growth model, but take a look at Japan, right? 250% debt to GDP is probably even higher now, 260, 270. And rates are, they're trying to get them out of negative territory, and they've only just done so modestly here. So I think what Mike mentioned is that what we've actually seen is a lot of spending over the last couple of years, and what we actually have approved through legislation over the last couple of acts from the Biden administration, whether you agree with it from a political viewpoint or not, you've actually seen some positive productivity gains out of that. And that actually creates a pretty good growth backdrop. So again, if you can actually see growth outpacing the level of spending, that makes it a little bit at the margin more sustainable. So yes, it's a problem that at some point we'll have to deal with, but it doesn't inherently mean just because you have high deficit spending, it's going to translate to higher rates. And there's really we don't know where that line in the sand is, and that might be scary. But basically when it comes to government yields and bonds, it's all about trust. And so you tell me where that line in the sand is, where people stop trusting the U.S. government to pay back its obligations. If we get to that point, we probably have a lot of other issues in front of us as well.
Yeah, I think there's a team at Wharton who tries to put a number to where there is kind of this falling off point, maybe 180% of debt to GDP. But Japan clearly is a different story, and I think you hit the nail on the head. And this may have been your team, and if it wasn't, I'm going to give you credit for it. There are, when you're in a deficit spend, there are better places to spend the money, and I think that's a great point of if the CHIPS Act, right, spending money in the semiconductor space, the corresponding dollars spent in deficit to that space and what you get in return on the GDP side is much different than spending it, in different areas. So whether you agree with it or not, the point is that there are better ways to spend deficit dollars that can grow your economy versus doing it other ways.
So is there any threat in your guys' mind of the dollar not being the world backer anytime soon, at least?
What are you going to replace it with?
The Chinese yen, right?
Yeah.
Yuan. Yeah, I mean, that's a conversation we have basically every single year. Same thing with deficits. It's a common conversation that we have with a lot of clients. And at the end of the day, when it comes, basically they're very interlinked. As long as the dollar is the reserve currency, basically you have forced buyers of U.S. Treasuries, and that's just how the global system works. If you have people buying goods in dollars, central banks from other countries have to park those dollars somewhere, and they have to buy bonds, U.S. Treasury bonds. So they're very closely intertwined. I think one of the stats that really hammers this home is, if you take a look at the amount of global trade that's denominated in dollars, it's well over 60, I think almost 70%. How do you change that global system? And if you are, it's going to probably take decades. First, you need a reliable alternative. Is it going to be the yuan? Probably not. There's capital controls. There's other issues in the Chinese government, certainly growth issues now. It's not going to be probably the euro when you have so many conflicting interests at play from a fiscal perspective among all those countries. So you got to start by giving me an idea of what's the alternative, and then it's probably going to take decades to get to that replacement point.
Bitcoin. Yeah? All right. Anyways, so
not go down there.
I joke. I hate Bitcoin. Anyways, so last question for you each. Same question. Answer it. I'd like both of your thoughts, and then we'll open up for a couple audience questions here. So looking forward, both are managing a lot of money. You're both looking at positions in the stock and global stock and global fixed income market. What are you guys looking to overweight, underweight? What are you shying away from? What are you leaning into? Garrett, why don't you kick us off, and then Mike, you can finish us out.
Sure. I'd say we tend to have a little bit more of a tactical viewpoint. So a lot of the money that we're managing, we'll have kind of a strategic core of our portfolios, but a lot of my time is spent on looking for those tactical opportunities, and that might be something that plays out over maybe 3, 6, 9 months. And if I'm looking at that kind of window, I think the backdrop that Mike alluded to, as we come out of the election season, one, we just don't have the election uncertainty anymore. And there's a lot to be said about just getting that result in the rearview mirror. And now we have some certainty about what are going to be the ground rules moving forward. And so, I think, what we've clearly seen is the market is reading a Trump administration as pro-growth. And I wouldn't lean against that. And then you put on what we've talked about today about, the Fed. They're basically providing a backstop for the labor side of the mandate. All of that's pro-risk. So if I'm building a portfolio, I'm going to be overweight equities relative to fixed income. I'm going to be overweight U.S. equities relative to the rest of the world. I think there are some opportunities in some of those small caps, the Russell 2000. But for now, I think we're still dealing with an environment where we're not quite at the point where interest costs have come down, and that's really important for small caps. So I still like a lot of the large caps. Have some exposure down to some of the smaller companies. And I'd be kind of barbelling my exposures there. So, the Mag 7, all those tech names, I think there's still a lot more runway on that trade. But at the same time, I want to be exposed to some of those areas of the market that are going to benefit from a stronger growth backdrop. So those cyclicals that Mike mentioned, I think, areas like consumer discretionary, strong consumer that continues to spend, industrials that are going to benefit from stronger growth, financials also very closely tied to kind of economic growth and interest rates. Those are areas that I'd like to lean into and are leaning to in our portfolios. And then on the other side of the ledger, if we're going to take more risk in our equities, then we're looking at basically providing some ballast, some offset to any sort of bumps along the way for fixed income. So we tend to favor higher quality U.S. Treasury bonds, not afraid of that, those deficit fears. But there are other ways to generate income. I think, Treasury bonds, looking at 4.4, almost 4.5 on a 10-year Treasury yield. That's a yield we haven't seen, for basically 20 years if you strip out what we've gotten over the last couple months here. We went an entire economic cycle without yields that strong from Treasury bonds. So you get a lot of opportunities to generate income in portfolios now, even without extending out into corporates and high yield, as Mike mentioned at the beginning. So generally risk on, lots of overweight equity risk, U.S. equities, cyclicals and tech, and then in fixed income. Offsetting that with a little bit of a safer portfolio dominated by a lot of those higher quality treasury bonds.
Can't say the same thing, Mike, so you're up.
Ditto.
All right. Garrett, my email for your resumes.
Sorry, Mike.
So I think if we just keep it high level, because I think a lot of our views will align with what Garrett said, but highest level, simple beats complex, and I think when people are always searching for alpha against something, right? Alpha is trying to outperform something, right? Everybody's trying to find the best stock or the best crypto, whatever you're trying to do. People underestimate just having beta exposure to the market. Having exposure to the market, the right exposure to the market, enough exposure to the market when you see what happened the last week is so vital to making sure you don't miss the best days in the market, right? Because the best days in the market, you strip out the 10 best individual days, you strip out half your return, right? So first and foremost, simple beats complex, make sure you have, call it the beta exposures, have the exposure to the markets. But at its highest level, we do prefer US large cap. We think international is clearly going to have some struggles. There's going to be a whole lot of volatility in that space. The dollar will probably appreciate as other countries try to devalue their currency to make any potential tariffs less of an impact. But to what Garrett said, I would totally agree as well. We're looking for so many years, and it's still going to happen as we move forward. But the Mag 7, right, those big 7 tech names have driven so much of the earnings growth of the S&P 500. And what we're starting to finally see are expectations around the other 493 names, right? Because there are a lot of really good companies in this country, but the other 493 names, plus the entire small cap universe starting to get back to positive and contributing earnings growth, quarter over quarter. So we're looking to take some of the gains in the Mag 7, which you cannot not own the Mag 7. They're too strong, they're too powerful, they're too much cash flow. Their bottom line is too impressive to ignore, but what you can do is take some of those gains and start to add back to some of these areas that are a little bit more relatively cheap, right? And then we're starting to see some tailwinds there. So, to what Garrett said, higher quality and fixed income, not that high yield can add value, but corporate fundamentals are so strong, you're not really being compensated a whole lot to take a whole lot of credit risk. You don't necessarily need to. So take a lot of that equity risk, lean towards the U.S., a little heavier U.S. large cap, but don't forget the other, 493 names, the other, areas small cap where there can be some value as we move forward.
That's awesome stuff.
Gonna keep my job.
TBD. Okay, so let's open. You've heard enough from me. I've asked a lot of boring questions, I agree. Why don't we open it up to any questions, because I'm going to ask what starter jacket they had soon. Phil, I see you cordially raising your hand so nicely.
Phil, you don't want I got you right here. Oh.
Gotcha, Kelly's got you back.
Thank you. Not on me.
Now, just scream it out. I can repeat it.
Good to see.
What starter jackets do you guys have?
Amazon. Okay.
Big old puppy Steelers.
You haven't addressed a couple of things. Our new incoming administration is talking about two significant things that might affect the economy. One of them is the talk about implementing some new tariffs, some of them very high, particularly from China. And the other one is deporting a lot of our immigrants. They're talking about 1 million of them. I don't know if that's the right number, but they are very important in our agricultural industry as well as construction industry and restaurant industry. And without those people, you're going to see a scarcity of labor, which means people, the companies or the farms will have to pay more for the labor if they can find the labor, and if they can't find the labor, there'll be a scarcity of food. Prices will go up. Tariffs implemented, prices will go up. Those companies are not going to just sit and pay for it and not pass it on to consumers. So how do you address that, and how does that affect the market?
Okay, so let's synthesize that down. So there's been talks with the Trump administration, as we know, tariffs and deportation, right? Immigration reform. Does that rattle markets? Is there a counterbalance? What does that do, assuming there's bite to these words?
Yeah, I mean, I think they're all valid points, valid concerns, and I think what we talked about earlier is if you're going to ask yourself what are the potential risks to the inflation upside concern, that's probably the biggest concern, right? I think in the short term it's still the labor market, but at the end of the day, this is where you do start to see inflation expectations start to pick up a little bit. And I think this is where the market's going to have some back and forth dynamic as to what it prices in, and maybe 2% isn't a realistic inflationary environment anymore. I think the key is, can that kind of environment, or can to some extent that kind of environment, anchor inflation still at 2.5%, 3%, and can growth continue to drive beyond that to really kind of withstand those inflationary pressures? But I mean, I think there's a lot of uncertainty, and that's what's going to cause some of the rattling in markets until we figure out, is what was stated from a tariff perspective, is the immigration reform exactly what's being stated, and what effect does that have on the inflationary environment? I think that's to be determined. And I think at the end of the day, if inflation becomes unanchored, I think that is clearly the risk to the upside on the inflation side, and you'll see bond markets and equity markets respond accordingly.
Right. Or these posturing techniques, which is also
That's what we have to figure out.
right.
Okay, good.
Yeah.
So worst case scenario, let's say they're not full of shit and they follow through on the things they promised in the election, leading up to the election. What's the worst case scenario?
Okay, so just to
And you talk about tariffs, it's not going to be tariffs, it's going to be trade. It's going to affect American manufacturing.
Read the question.
yeah, wait, one second.
Worst case scenario.
So the question is, let's say it's not posturing. Let's say that, and I read numbers, it could cost billions of dollars or $1 million, $88 million or something, and for mass deportation and tariffs. Let's say there's a lot of bite to the bargain, right? Play that worst case scenario out, Gary.
Yeah, so this is something that I think everybody in the markets are thinking about right now. At the surface, right? Putting on tariffs seems inflationary. One, I like to push back against that because it's not, inflation is a process, right? It's a process of prices continuing to move higher. Tariffs are not that. They're a one-time level step higher. So the risk, as Mike mentioned, is does that then seep into consumer sentiment and consumer expectations? And if it does, inflation expectations start to rise, that's a problem because expectations can actually change behaviors, and then you can start to be getting an inflationary process because that starts getting baked into wage setting and negotiations on that front. That caveat aside, I think what you're alluding to is absolutely right. You can't just look at it in a vacuum, right? If you put on a full-out trade war, you're going to have negative growth effects here domestically and on a global basis too. So now start bringing that back to markets. The mega caps, 7 names, they're not generating all their revenues domestically. They're generating a lot of it abroad. If you're seeing lower growth on a global basis, you're going to see revenue growth for a lot of the biggest companies in the market also dragging down here. So, I think we can debate and talk about all the worst case scenarios all we want. I think the way markets are thinking about it right now is that, just run back the same framework from Trump's first administration, which is take Trump seriously, not literally. Now, whether that plays out remains to be seen here. I think there's a lot of uncertainty as to whether or not there's guardrails around Trump in terms of how aggressive he wants to go on some of these policies. What I will say is that the ultimate guardrail is the markets themselves for any president, but certainly for Trump. We've seen that in his first administration, but that will have significant implications for what midterm elections look like here. So the question becomes, how much pain is the Trump administration willing to endure to push some of these agenda items? The worst case scenario, it's not good for anybody and everybody loses. But when it comes to markets, when it comes to the economies, what you tend to see is those worst case scenarios don't tend to play out because everybody has incentives to prevent those from playing out. So yeah, it's a fun game. I think it's something to keep an eye on. Not necessarily fun. It's an important game to play and kind of plan for. But I don't know that that's actually the reality that we'll see come to fruition. But that's something that markets are absolutely going to be grappling with. I think right now we're still kind of in a sugar high. Let's focus on the pro-growth agenda items. That's going to start coming in and mattering a lot more for the market narrative and market action as we roll into next year.
Bye.
Hey, in the spirit of what Phil and Richard had said in the new administration, the Fed dual mandate, you guys talked really well about that. They've also been able to remain independent, and there's some suggestion that the new administration will want to have some influence over Fed policy. What's the impact of political pressure on the Fed, and is it possible for them to remain independent?
Yeah, that's a great question. Was it Greenspan that brought it independent, I believe, way back when? I think so. We're going to say it is.
Yeah.
Quoting by Mike Horwath. So yeah, it's a great question. So there has been talk that, for starters, Chairman Powell runs the Fed. His term outlasts Trump's, as we know. So he, in theory, and they run separately. Again, just a little background for those that aren't savvy on the Fed, as fun as that is. So they run separately, and there's always been the separation of church and state, where they work in concert together, they can influence one another, but at the end of the day, they want to separate them so that no president can actually influence the Fed. And those two gentlemen have been at odds, and I think I read today that Powell said if he has to, he'll fund a lawsuit himself, right? Does this play out? Is there a real threat here, guys, of a shift in how the Fed is monitored?
From my perspective, I think you saw Fed Chair Powell, because it's a great question. You saw him come out, and his face told it all, right? He has no intention of stepping down, and I think he truly takes his job to heart. Right? You don't do that job because you make a ton of money, right? You do the job because you love what it is. You believe it has a purpose for being independent and for influencing, U.S. monetary policy. I think as long as he is chair, they all have their own biases, right? They all bias towards more of that kind of hawkish or dovish view, and governors will vote the way that they vote to maybe either hike or cut rates or hold rates steady based more on that internal bias. But I don't look at it as long as Chair Powell is still Fed chair. I don't see political influence seemingly driving him. But once again, you're taking his word at face value. But
Is there a threat that no longer, I mean, there's a threat, is there a bite to it in your mind? Can that actually play out?
Well, and I think more recently we've seen, that statement get backed off, right? This may be one of those things where it maybe was more bark than it was bite, where it was, hey, once I get in, I'm going to get rid of Chair Powell. But what you're seeing is that, maybe we'll just let him finish out his term. And, look, I think that's the best thing for markets. And we come back to what would that do to markets? I think that would certainly rattle markets. And there would be a lot of negative consequences. And, candidly, what would you do differently? And I think that's what you have to ask yourself if you were in Chair Powell's shoes. So I think, he said, he's going to have his own biases, internal, but he has said he wants to remain independent. He believes he can stay independent. And I'm not overly worried about it. I do think if he is forcefully removed, that would cause more of a problem than anything else.
Yeah, I'm certainly not a fan of that, anything changing in that regard. Let's take, in the interest of time, and Joel Embiid is back tonight, folks, playing. What's that? Yeah, I was going to take one more question and then leave you with some remaining remarks.
So guys, a couple of things on the topics that have been raised so far. First, Powell's term expires in May of 2026. Trump has already made indications that that will not be renewed. By law, he can't take over monetary policy. However, if you guys think back, you guys are too young, but for those of us that aren't, Reagan had a person in place that he could heavily influence. And if you look at all of the economic data from Reagan's term, it was horrible. It took a year to get in place. It took time. These things don't happen overnight. So my big worry on the Fed is that Powell is replaced with somebody that's either a Trump crony or somebody very favorable to Trump, and then he has much more influence over monetary policy, which will kill us. Back on the other, on tariffs, having had firsthand experience with it, the unintended consequences of tariffs could be severalfold. One, yeah, we raise tariffs and imports to the U.S., whether it's from Mexico or China or whichever countries, are just higher costs. Prices go up. For U.S. domestic manufacturers of in-kind products, they're going to raise prices too, because the next best alternative now has a higher cost of getting in across the border. And then the third consequence is it's a game of whack-a-mole. So a lot of companies are going to invest capital that have what I would term portable manufacturing assets. For example, textiles and apparel. They'll pick those up out of China, move them to other low-cost countries. And so it's going to be a game of chasing your tail, but it's going to put a lot of confusion, I think, into the markets while that game is going on. And we all know from the 2016 term that Trump had, he's not a good loser. And so the reactions to that game taking place are what concern me more than the actual applying tariffs as a threat to negotiate some other deal for the administration. What do you guys think about all that?
I like one-word answers from each of you.
So I'll just take your first
Satellite
question.
boys and girls.
First question in regards to Fed independence. I think that is incredibly important, and as Mike already mentioned, the biggest guardrail there is just going to be markets. And markets specifically on that one is going to start with fixed income. That's where I think you'd see the biggest reaction, probably higher yields, and that's going to have negative effects, across other assets, specifically equities. So yeah, it's a risk. Powell's term as chair ends in 2026. I think he's still on at the board of governors through 28, I think. But obviously his sphere of influence shrinks quite a bit if you're no longer chair. So again, I think that's an area where that is a risk. That's a little bit too far down the road right now for markets to actually be considering. But again, I think there's a significant guardrail there from the potential negative ramifications in market pricing as a result. So that is something that I think if you can basically put into all of these issues, markets are kind of the biggest defense you have against some of this, because that has very important implications on everybody's portfolios here. Whether you're a layperson or in government, everybody gets affected on that front. And that has important implications for elections that we just saw. So I think that's something to keep in mind. On the trade front, yeah, I think that's the biggest question mark that people are asking right now is this kind of a bargaining strategy, negotiation strategy or not? And I don't think anybody has that answer. Those are all tactics that we've seen. I think companies have gotten pretty good at that, to be honest, shifting production facilities, skirting some of those tariffs. And honestly, that's a byproduct of the COVID era environment where you saw a lot of shifting in terms of trying to bring production maybe to areas that you don't have to rely on transportation as much or friendshoring. Those are already kind of themes that are underway. So, I don't think the disruption to businesses are as much. Again, it kind of comes back to what are the justifications? What's Trump's objectives with tariffs? Is it really to get a deal? Is it really to replace income taxes and generate revenue for the government? You have to kind of answer those questions, and that's going to tell you what the potential risk is from tariffs. But a lot of these questions aren't as simple as what they sound. Tariffs are inflationary. Well, they could actually be deflationary because you could actually lead to lower manufacturing employment domestically. If people are spending more on specific line items that are tariffs, now they have less money to go around elsewhere. That can reduce employment in those sectors. So there's a lot of ripple effects, and it's all kind of game theory. So yeah, again, we could spend all night talking about some of these issues. Those are absolutely the right questions to be asking. I don't think, unfortunately, anybody has answers to those now, and markets aren't going to be trading off that, at least in the near term.
Love it. Thanks for the great questions, everyone. Here's what I hear. Here's as I'm sitting here reflecting on everything I've heard and the great questions, is everything's fluid. There are a lot of things interconnected here, and it gives me great confidence to know that we have great people and resources like Mike, Garrett, and all their teams behind us to continually ponder these questions and also play out the theses of what actually transpires, because there is a cause and effect to whatever happens. We don't know what the future is, but I do personally, and I hope everyone here feels even more conviction and confidence listening to these great gentlemen speak with such intellect and knowledge and foresight as they have, that whatever we go through, we will go through together. Whatever transpires, we have ways to combat it, and this time is not different. So I want to really thank you guys. Remember, if you mention Diversified at your local Joseph A. Bank, you also can get a financial analyst costume. So you get a 25% discount. But in all seriousness, we love you guys. I thank you for coming out, and we'll do this again next year. We're here to support you. Questions not answered, shoot them our way or to your advisors, and we will get them answered. And I appreciate all your trust and all your faith in us, and we don't take it lightly. We take it very seriously, and we will continually improve and give more value and more benefit and more client experience to you. So it is because of you we are here. This is all put on for you guys, and because of you guys, we love you very much. And let's go Sixers. Let's go Joel. See you guys.